Hey friends, David Meek, All Pro Mortgage Advisors Group, residential mortgage lender. Wanted to show you today a quick simulation of the all-in-one mortgage. Now, I know many of you all have heard me talk about this loan over the last however many weeks or months I've been talking about it, but I don't think I've shown anybody an actual simulation, and I thought I'd do that today. First thing we're going to do is start a new simulation. And it's going to ask us, are we comparing this to a new loan comparison, as if somebody was shopping mortgages currently, or are we going to compare it to an existing mortgage? In this case, we're going to do a comparison to an existing mortgage. And let me also just share a couple of quick tidbits, footnotes, whatever you want to call it, getting started. This is a real scenario. I'm not going to use anybody's actual name. But this is a recent application that I've taken for a couple that just bought a house in July, and we were doing a comparison between what they did and what they could have done, basically. And so they're actually most likely going to end up doing this refinance, but I thought it was a really good example to show you. That said, this couple is somewhat of an anomaly, meaning they live pretty aggressively below their means, very frugal people, and so I didn't think that would be fair to show their actual numbers. So I'm going to pad some of these numbers a little bit to the negative, actually, making the final result less favorable than what it really is for them. But it's still going to show you the power of the product and the savings potential, even for a couple that maybe isn't as frugal as this couple. So with that said, let's move forward. All right, they are a primary residence in this case. However, quick note, you are able to put this loan on a second home or an investment property if that's something that you're interested in doing. And so let's move forward. So $336,000 is what their house is worth. Current loan amount $268,800. It is a 30-year fixed that they have, and that rate is 7.875. They just got the house, like I said, so they're only 1 month in. This is their current principal and interest payment, $1,950 and some change. They're not currently making any extra principal reduction payments. They're not planning to. There also is no second mortgage on the property, so we can move forward. This is asking about their income, how many recurring or repeating deposits are made into their checking account. And in this case, 2 people in the household, one's only employed, one is employed currently, the other is expected to be employed soon. So to get started, let's just go on ahead and work with the one income. So basically they get paid an annual salary and they earn income monthly. It works out to right at $100,000 a year. So we're going to work with that for now. And now we're asking about expenses. This is where I'm going to deviate a little bit from their real scenario. So first, though, we need to adjust the taxes and insurance. If we didn't know specifically what they were, this is actually a pretty good estimate, and it's padded a little bit on the high side. But in this couple's case, we do actually know what it is because they just bought their house. So their actual total is $336.84 for that's their homeowners insurance and their property taxes combined, which makes their total comparison payment that they're making right now. When you'd add the two together, $1,950 plus the $336. That leaves a remaining amount of about $6,000 per month. So the question is, how much of this $6,000 do they actually spend, or how much is left over at the end of a typical month? And so in their case, it's very, very low. They live way below their means. But for our examples, we're just going to get started saying that they spend, of the $6,000 extra per month, they spend $5,000 of it, which leaves right at $1,000 left over. And this is what we would call, in budgeting world and financial services language, expendable income. So this is, what's left over extra after, income received, taxes paid, everything, blah, 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 car payment, student loans, etc., utilities, gas, groceries, etc. They've got $1,000 left over, and they can do whatever they want with it. Now, some couples will take that and they'll just bank it. Some couples will make principal reduction payments, etc., so forth. And so that's the question: what do they have left over? In this example, this scenario, we're just going to assume we're right at $1,000, and we're going to calculate the results now. And there you go. First, we're going to look at the traditional mortgage side, which is on the right here. What that shows is this is our original principal balance, $268,800, and on the current mortgage that they've got, assuming they don't pay any extra principal payments over the course of the next 30 years, they will pay back $431,000 and change at the rate of 7.875, which is what they've got currently. They've got 359 remaining payments, and that's a total of $700,000 they're going to pay back on a loan that they borrowed of $268,800. They didn't even borrow $300, and they're paying back $700. That's how the math works on a traditional mortgage. And this is pretty common. So, I mean, this doesn't mean they're getting screwed. That just means that's how the math works on a typical forward amortization, 30-year in their case, but on any kind of fixed rate loan, you're going to see the same kind of things. Now, compare that to the all-in-one example. And this is based on the numbers that we put in, obviously. Same loan amount, $268,800, but notice that the interest amount that they pay is way less. It's $200,000 instead of $431,000. So the total of the two, $268,000 and $200,000, comes together of $469,000 and change. They're saving, in this example, over $230,000, almost $231,000 in interest, and they've cut their payments down from $359 to $160, which means they're going to pay the house off in less than half the amount of time at that current rate. That's not a guarantee because, some months they may actually end up spending some of that $1,000, right? Not all of it's always going to go to the principal, but that's the idea. Why does this work? Well, because on a traditional amortization schedule, people aren't paying down their principal very quickly. The amortization schedule is designed to pay down interest first and then the principal, and it pays more interest at the beginning, and then as you get through the payment schedule, you're paying more and more interest and more and more principal and less interest. The all-in-one loan reverses that. It pays down the principal first, and then it applies that extra expendable income to the principal every single month. So you're accelerating how fast you're paying down this loan principal, which in turn saves the total amount of interest that you pay. Now, one big concern, and the reason why technically a person could do the same kind of program with a traditional mortgage if this couple wanted to, the question might be, why not just take this $1,000 each month and apply it to their on top of their normal payment? Well, could they? Sure they could. They're going to pay down their loan way faster in that case. They're going to save a boatload in interest in that case, but they're going to lose access to that $1,000 because on a traditional mortgage, when you put money toward a principal reduction payment, it's gone unless you borrow it back some way, either cash out refinance or home equity line of credit, or liquidate the asset, aka sell the house, and then take the cash. That's a one-way transaction. So you can do it. It's saving you money, sure, but it's saving you money in the long run, not today. And you lose access to the money. With the all-in-one, every month they put that $1,000 extra toward their loan. They're paying down the principal. They're immediately getting the benefit of interest savings, but they don't lose access to the money. If they need it back next month, they can get it back next month, which is, as long as they haven't, taken it out already and spent it on something else. But that's the idea there. All right, quickly, and I was trying to keep this thing under 10 minutes, and I've got under 2 minutes left. So let's go back and adjust this a little bit now to add the second income. And so in this case, we're going to assume the second person is going to make about $36,000 a year. That's $1,500 semi-monthly. And that is going to go next. And so now, obviously, their expenses didn't dramatically increase. We had it at about 1,000, at the 5,000 mark before. So let's assume that the number's still pretty close to that 5,000 mark. But maybe let's say they're spending more on gas because they're driving. Let's put it at $5,500. Actually, you know what? Let's go less than that. Let's just say that their total expenses are $1,200 a month more now than what they were. They're making more money. They're being a little more, say eating out more often or something like that. Obviously, this is just simulation. But let's say that they're only saving now 25% of their income left over on a monthly basis, which is $2,800 instead of $1,000 because they've got, $36,000 a year and more income. Calculate the results, and boom. Look at that. Under 7 years, this couple would pay off their house in that scenario, and a savings total of $345,000 in interest compared to what they're paying of $431,000 in interest. It's hard to argue with these math, and so obviously there's some more details to go into, but this was just a quick simulation to show you the power of this product. If you'd like more information, please reach out to me. You can find my information on my website, allpromortgage.us, under the contact tab, and that's it. David Meek signing off. I'll talk to you later. Have a great day.